Tom Leahy, you are head of EMEA Real Assets Research at MSCI. Thank you for joining us on BiTV.
Thanks for having me.
1 year ago today, Russia started its invasion of Ukraine, which had wide-ranging effects on global markets. What were the main impacts on the European real estate markets?
Thanks for the invitation to speak. I think there are probably two ways to look at it, the direct and the indirect impact. So the direct impact on markets around Ukraine and Ukraine itself seems to be minimal. The data that we have shows very little institutional involvement in the Ukrainian real estate market, for example. So that itself is not particularly a concern to the major institutional providers of capital. It also doesn't seem to have directly impacted investment in countries close to Ukraine. Places like Poland have not seen a particular impact on transaction volumes, maybe linked directly to the war and the invasion. For Russia, some international institutions have capital invested in Russia, and that they will obviously have seen an impact, especially through the sanctions regime. I saw recently that Heinz, who are probably the most well-known owner of Russian real estate, are exiting their portfolio in Russia. So that's an example of how the invasion has had an impact on their business. So that's the direct side, but I think the better way to think about it is indirectly. And that's through helping to embed inflation in European economies through higher energy prices. Now, obviously, energy prices have come down significantly from their post-invasion peak, as we've had a relatively mild winter across Europe. But nevertheless, the increase in higher inflation caused central banks to increase interest rates from what had been record low levels. So property has enjoyed an extensive period of loose monetary policy, which has pushed capital into the asset class from other asset classes, primarily fixed income. And so that's pushed all that capital into real estate. It's pushed up prices and pushed down yields. And that situation has now gone into reverse. So the higher inflation, higher interest rates led to higher cost of capital. So debt prices really rocketed through 2022, and that led to uncertainty over pricing in the market. Real estate pricing is priced relatively off bonds and cost of capital. And so that higher cost of capital led to the uncertainty over pricing, which manifested itself in lower investment volumes. And that's true of the vast majority of European property markets, some more than others, though. So, for example, German investment has slowed very much over the course of the last 12 months in comparison with 2021. And there's some base effects there too, with some very big deals that happened in 2021, but also I think sentiment in Germany was badly impacted, particularly because of Germany's prior reliance on Russian energy exports. So they've had to reorientate their energy market. Whereas a market like France may be slightly less impacted by that, with a relatively substantial nuclear power base. Inflation didn't climb as high in France as it did in Germany, for example. And another market that's badly impacted was Sweden, where the higher cost of capital has particularly affected some of the big listed real estate owners in Sweden who've been struggling with their debt burden. And so that's manifested itself in very, very slow year for property transactions.
Thank you. In a recent report, MSCI also states that Russia's invasion seemed to signal a new era for commercial real estate. How would you characterize this new era?
Yeah, well, I think that's all linked to the story I just mentioned, which is the inflation and interest rates. So, as I said, we've had this extensive period of loose monetary policy, and that now seems to have come to a close. So the previous let's say the post-GFC cycle was characterized by low interest rates, low returns. It seems like we're moving into a higher rate, higher return environment now. So I think the question is, where does real estate fit into that higher rate, higher return environment? Are capital raisers going to find it as easy to pull capital in from investors that they have done in the last 10 years? That for a while there was that catchphrase going, the acronym going around, which was TINA, T-I-N-A, which was there is no alternative. So when you've got negative interest rates in Europe, for example, the positive return provided by real estate was invaluable for investors, especially those with future liabilities. But that now seems to have changed, as I said, and so real estate has to sort of carve out a new niche for itself and restate its attractions in a sort of multi-asset landscape. And so I think that's really the challenge for the industry, is how it adapts to that higher rate, higher return environment that we seem to be moving into.
Yeah, thank you. Because that's the thing with a new environment, this new normal. What could be maybe the most lasting effects of this geopolitical conflict on the European commercial real estate markets?
If we think maybe more about the end of that low return regime, I think the longer question is how much capital will be available to invest in real estate over the medium to long term. And how attractive is real estate going to be? As I said, that's a question that the industry has to grapple with. I mean, there are clearly reasons to keep on buying and investing in property, as there always have been. You know, there's a huge opportunity to decarbonize the sector, for example. So real estate accounts for up to 40% of all global carbon emissions. And so there's a huge opportunity there to try and decarbonize the sector. And that, you know, not only will do good, presumably, you know, for investor portfolios, but also for the world around us. There's a need for affordable housing in many European economies, and a lot of investors are leaning into that as an opportunity. So there are reasons to keep buying real estate. It's just that the kind of real estate acting as a bond substitute, that period seems to be over now.
Thank you very much, Tom Leahy, for this very interesting insight. Thank you all also for joining us, and see you soon on BiTV.
Thanks.